Managing personal finances can seem daunting, especially in bad times, even good times as well, come to think of it. And the traditional tools out there seem to focus more on restrictive budgeting. Research is also showing that Gen Y, millennials that is, and also Gen Zs are going to AI more and more these days. So the point is, how do we do all of this? Do we DIY, own self-do type of thing? Do we get the robo-advisors in? Do we maybe just fob it off to the professionals? Here's what we're going to figure out. It's Money Hacks. Welcome to the show. And if you have feedback or an episode idea, you can always email us, btpodcasts@sph.com.sg. I'm Howie Lim. Helping us figure everything out today, we've got Isaac Ong. He's a client advisor at Providend. Also, Tim Phillips, content creator, timtalksmoney.com. Gents, hello.
Hey,
Hi, Howie.
Howie.
Great to be here.
Yeah, very good to be here.
So what do you reckon? What team are you on? Team DIY, team robo-advisors, team fob it off to the professional? Let's start with Isaac.
I'm taking a more balanced approach when it comes to this kind of thing. I think it really depends on your needs. Right? I don't believe that everyone should be DIY, nor should everyone go to professional wealth management, right? So I think it really depends on your needs, and before we decide which we should go for.
When you talk about needs, is it size of your assets or what do you mean? Life goals, that sort of thing?
I think size of your assets can be an indication, but not all the time, right? Of course, typically a person will have their retirement needs, their children's needs, for example, children's education needs. But for high net worth, probably would have things like legacy needs as well, right? If they're going to leave behind a substantial sum of money, right, how do they do it in a way that would still maintain family harmony?
Just to make it clear, let's say we're talking about everyday folks like me. Tim, what do you reckon?
Well, I mean, going back to Isaac's point, I mean, I think it very much does depend on the person, but I think it would be maybe remiss of me not to point out that there are trade-offs, right? I mean, if you do DIY, you are hopefully, I would assume, getting into low-cost ETFs and you're saving on cost. If you do go down the advisor route, I think there's the value add there, but it's more suited to individuals that maybe don't have the time, don't really want to manage actively their money, and they need a bit more hand-holding from the psychological perspective. There's a market crash, people like Isaac will be there to tell their clients, don't sell, don't be rash, stay invested. So, I mean, I think there's a lot of value in each different channel. It's just understanding you as an investor. What type of investor are you? And which channel suits you best. And also to add on to that, I would say you don't have to go with just one and reject the other two, right? You can have assets in each of those avenues, and you can dial up and dial down according to maybe your needs and your personality as well.
So it's almost sounding as though a DIY plan wouldn't be just yourself. There'll be a bit of robo, there'll be a bit of I have fobbed some of it off to a professional maybe. Is that what it looks like?
Yeah, I think defining what DIY is important. DIY could mean stock picking, right? It could mean going into really more sophisticated instruments like options, for example.
DIY ranging from buying some sort of, Dogecoin up to putting it into an S&P 500 ETF. There's a very wide divergence there in terms of your risk, right? So I think it's important understanding that risk that you're taking on the DIY scale versus the risk. If you do go with an advisor, there will be probably an asset allocation plan, a responsible, 60-40 or 80-20, whatever it may be. And understanding you as an investor, are you going to sell out when there's a market sell-off? And are you going to be buying lots when the market goes up really high? So a lot of these behavioral sort of impulses, I think we feel as humans, which is just natural when it comes to money. And I think recognizing those biases, recognizing your own personality, that's going to give you a better take on which route you should go for.
Let's maybe simplify, and I'll use me as an example. I'm extremely risk averse. I'm the sort who may, metaphorically have the can of Milo with my cash under my mattress sort of thing. And so what should I be doing if it were a case of DIY? Isaac?
I think we have to look at the pros and cons of DIY first for me to answer that, right? So DIY definitely is lower cost, right? Because you cut out the middleman, essentially. So you save cost on that, right? And DIY gives you a lot of control of where your money is going exactly, right? If you are going with a robo, when you are going with a professional wealth management firm, they will give you some options, but they will essentially be dictating where your money is going, right? But the cons of it, of course, is it can take a lot of time. You need to have a lot of interest in it, and of course, you have to be good at it as well.
Yeah, so I mean, I think that what I want to pick up on from what Isaac was saying is really the time aspect of it. I think if you go down the DIY route, you first of all have to have the time to do it, or dedicate some time every week to understanding it and educating yourself and really taking an active interest in it. And then B, also just you reading up and being aware of what's happening in the world, in markets. And if you don't have the time or the interest, then I think going the advisor route, also going the robo route is perfectly acceptable. I think it's really dependent on how much of a role you want to play in your own management of money.
What then would a pro's plan look like? Should someone like me who, say, wants to fob it off to a professional, who wants to have a professional do it for me, have eyes on their plan for me?
Yeah, I think similar to DIY, there's a spectrum, right? I think for professional wealth management as well, right? You have wealth management firms that focus on trying to generate alpha, right? They actively manage your portfolio, they perhaps take more risk. Whereas the approach that Providend take is essentially looking at investments sort of like a solved equation, right? I think the stat is something like over a period of 10 years, 80 to 90% of actively managed funds underperform is benchmark, right? So for us, instead of trying to be that 10%, right, why don't we just accept being that 90% and we focus on the other side of the equation where we have more control? Because as much as we all try to think that we can predict the future, what the markets will do, especially in the short term, is something that's beyond our control. So why not we focus on the other side of the equation?
Yeah, lots of people chase the market and
Yeah.
I think ideally the pro would have a session to understand you on a deeper level, right? Because everybody's needs are very unique, right? The stage of life that you're in terms of your family, do you have kids, are you married? And of course, to understand your life goals as well. All those information are required before we can actually give advice to that person.
I think that maybe the pros we can see, it's professional. You have maybe portfolios that are set to your risk tolerance level, and so it's very simple and straightforward, I think, to get it started. But I think in general, the wealth industry here, the interest of clients doesn't always come first. There's a lot of misalignment of incentives for clients and for advisors who are selling products. And I think that's to the detriment to a lot of clients, personally. I mean, I've seen it a lot of times. It's not worked out well for people. So I think that's something that if you are thinking of embarking on this journey, you just need to be aware of.
It's
I
the
think
fine print you're talking about,
Definitely
right?
the
That
fine
they
print,
make
yeah.
really, really fine.
Really fine, and you don't really realize it until maybe you need the money or you need to stop paying your monthly premium or whatever it is that you're paying for maybe an ILP. And then there's a penalty fee, there's this, there's that, and they make it basically impossible to sort of get out of, right? So I think that's something that you go down that route, just be aware of what you're paying, I would say.
Tim, what about AI? Earlier we were talking about how millennials and Gen Zers are using more of it when it comes to personal finance. Is AI considered robo, for example? I mean, what's the tech term?
I don't think there's anything revolutionary going on right now in AI as it relates to applying it to wealth management or understanding investing. And I think there are a couple of reasons for that. First off, finance is generally late to the party with new technology, but also there's a lot of compliance and regulatory issues that have to be adhered to, right? And maybe that can't be fobbed off to AI. Maybe there is going to be oversights, and if there are oversights, there are going to be big penalties, right, for firms. So I think firms are probably going to take a little bit more of a cautious approach to AI and how they integrate that into any investment decision process or how they integrate it into wealth, right? So I think it's a bit more referring to, I guess, robos. I'd say robo-advisors, and that's obviously your big platforms in Singapore, your Endowus's, Stashaway, Sifes, those guys, and that's more just putting things on a digital platform, making it easy for people to invest, making it user-friendly, putting it on mobile, anything that is sort of technologically savvy in finance is going to be called robo, even though it's nothing to do with robotics. So I think it's anything that is more just easy to use and digital. That's a big step forward, I think.
What about you, Isaac? How do you feel AI is shaping personal finance now?
On Tim's point earlier, he mentioned that a lot of people think that robo-advisors are actually using AI to do their trades, but most are not. You can think of it as a package product, right? So for robo-advisors, they'll ask you a few questions, and then using the algorithm, they'll find out what sort of asset allocation or what portfolio mix is suitable for you. My thoughts on AI, there are some firms that are using AI to trade. And if you are an accredited investor, you probably have access to those instruments. How would it influence the market? Well, if the algorithms are trading well and they're making sound, informed decisions, that can actually make the market more efficient. And for passive investors, that is a good thing, right? Because the more efficient that the market is, the better it is, right?
Trends come and go, so to speak. And recently, at the time of preparation, I was looking at what might be the personal finance trend of the day, du jour, if you will. It was the no spend trend. What do you think? You try as hard as you can to not spend anything for as long as you can.
For us at Providend, at least, when we speak to our clients, it's really not just about achieving your financial goal, but making sure that you achieve it in a reliable and comfortable manner, right? So if you don't spend and you save a lot of money, yes, you may achieve your financial goal earlier, but you're probably miserable now, right? So it's about finding that balance. I think that's really important.
I don't know about you, Howie, but that sounds really depressing. And it's not really a healthy and sustainable way to live. I mean, it's kind of like those people who do a dry January and then just go back to drinking in February. Like, okay, do it for like 2-3 weeks. Great. Are you going to do that for the rest of the year and for your life? No, probably not. Or 99% don't. So I would say focus on the big issues, the big costs. There are things like insurance, there are things like housing, and those kinds of costs are big, right? And I think the same goes with fees. I mean, people get really worked up about $1 increase at whatever the chicken rice at their local hawker center, but they're not really thinking about maybe the sort of 5%, 10% sales charge that they're getting charged on like a $10,000 fund. So, you know, there are things like that where we really should be focused more on the $10,000 or $20,000 questions rather than the $2 questions, right? And it's a misnomer in finance because a lot of things like in luxury, you'd say, oh, you pay more and you get better quality. Like maybe you're getting Hermes bag or you're getting a Hugo Boss jacket or something. And sometimes in finance, it works the reverse way. You pay more money and you actually get worse performance. And you pay less money and you actually can outperform or you can do better. It's something that I've been really passionate about, is just thinking about fees, understand what you're paying, and are you getting value for money? Because if you're not getting value for money on your sort of $5 chicken rice, you really need to be thinking about, are you getting value for money on your wealth?
You sure sound like Team DIY, Tim. Feet to the fire. Is that what we're talking about, Isaac?
Yeah, I think I agree with most of what Tim said. Maybe not the part about how if you spend more money on luxury items, you get better quality.
Oh,
Yeah.
no. I think that's a
No.
whole different topic.
There's
Yes.
a topic there. Yeah, definitely.
Yeah, but I think mostly yes. If let's say you're paying unreasonably high amount of fees, right, and you could be saving like $2-3 on your daily expenses, your chicken rice, or not taking Grab, for example, to work, right? But you're behind the scenes, or what you may not be aware of is that your investments, a lot of it is eroded by all these high fees. Our take about fees is that if you are paying fees for outperformance, the odds are really not in your favor, right? You're likely going to get underperformance instead, right? I think that's important to note.
Yeah, I would also add, like, we're all starting on the same level playing field, right? Just because someone has $10 million and someone else has $10,000 doesn't mean the person with $10 million knows anything more about investing than the other person. I've personally seen a lot of really rich people make very bad decisions on things and buy really terrible things or take very bad advice and lose a lot of money. But I think the key thing is when you do start investing is to really just educate yourself about the options, what's out there, what's right for you, pricing. And I think that's just going to put you in good stead.
I wish we had more time. Thank you so much for your insights today.
Thank you so much for having us.
Thank you, Howie.
Okay, I tried. Feet to fire, they didn't budge. So I couldn't figure out whether or not they wanted you to DIY, whether or not they wanted you to robo-advisor it, or just fob it off to the pros. Anyway, Thanks for joining us today. This is Money Hacks from the Business Times. If you have feedback or an episode idea, be sure you email us, btpodcast@sph.com.sg. I'm Howie Lim.